Excel accounting practice problem. Reversing entry related to unearned revenue or customer deposit. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the Excel worksheet from a blank sheet. Now continuing to enter transactions into it. If you have access to it, there's two tabs down below, an example tab and a practice tab. Practice tab starting out where we left off last time. The example tab in essence being an answer key. Let's take a look at it now. We're focusing in on the unearned revenue, now looking at the reversing entry. Last time we did the adjusting entry, noting it's a little bit different of an adjusting entry that you might see in a book or text problem, in which case you would typically have the unearned revenue increasing when you record the sales for a type of industry where you get paid before you do the work, and therefore the unearned revenue would just be simply increasing as a liability type of account. Then you would have to determine periodically at the end of the month, presumably, how much of that revenue had been earned, reduce the unearned revenue, and record the revenue down below. Now, in practice, we noted that we could have a situation where instead of having the unearned revenue increased as we have the sales being made, we might have a different type of problem than simply recognizing when the revenue is created, and that's going to be tracking the invoice that we expect to create later on for the deposit, the advance payment we received in advance. For example, the advance payment for something like a guitar we got in advance. We're then going to be invoicing at a later time. If we were to make at the point in time we got the advance payment an increase to a liability, we couldn't easily track it within an accounting system like QuickBooks as we can if we made like a negative asset account, and then later when we create the invoice, recognizing the revenue at that time, we can tie out and match out the advance payment to the invoice. So our problem then is that if we have unearned revenue, meaning advance payments in this case, at the end of the time period, then we need to basically account for that so that we can present our financial statements correctly on an accrual basis by increasing the accounts receivable for those negative amounts and then recording them as a positive liability. But we only want to do that for the presentational purposes. So if I enter that into, say, my accounting system like a QuickBooks system, that will mess up the accounting department's job. And their job, they're doing fine with their method, which is simply to have a negative receivable. So what we would like to do is reverse it back out of unearned revenue and back to that negative receivable kind of portion or method so that the accounting department can continue doing what they're doing, which is working fine for what they are doing. So that's going to be our objective this time, noting that as we do the reversing entry, we're going to reverse it as of the first day of the following period. One question you might ask is you might say, well, shouldn't I reverse it at the date that we're going to receive the payment, for example, so that I reverse it and I'm closer to an accrual basis for a longer period of time? The point of our adjusting and reversing entries, however, is not to be closer to an accrual basis during longer periods of the month, but rather to make the endpoint when we're making the financial statements shown on more of an accrual basis or the accounting method that we need to present the financials in. And for the rest of the time period, we want to basically make the accounting process as easy as possible. So to do that, the cutoff date, we're going to make the cutoff date as succinct as possible at the end of the period, all adjusting entries. And then the first day after that, in this case, March 1st, will be all of our reversing entries, so that if you're looking for our adjustments and reversals, they will be easy to find. And so that's going to be what we'll be doing here. So we'll go back to the practice tab now. So this is where we left off. We've got unearned revenue up by the 450. Let's take a look at the subledger just to get a better idea of that. Subledger related to accounts receivable. Undo that. Related to accounts receivable all the way on the right-hand side. You'll recall that we had these two customers, Smith and Eric Music. We had to look at the subledger to determine if we had any of these advance payments in the accounts receivable. We determined that we did for 450. Then we increased the accounts receivable by that amount, and then increased the liability by that amount to adjust for it. But if we record this into the accounting system, they're going to force us to hit the subledger, or may, like a QuickBooks would make us hit the subledger if we used an accounts receivable account. And bookkeepers are always afraid of that. Like if you're working with a bookkeeper and you're saying, I'm trying to make the financials correct for presentation purposes, would you enter my adjusting entries? They're going to say, oh no, they put something to accounts receivable, and I don't want to do that because it's messing up the subledger. So you want to be able to recognize that and say, okay, we're not going to hit the subledger for those actual customers possibly, but possibly make another customer so that we entered into the subledger over here as of the end of the period for these 2 adjusting entries we did, and then we would reverse it the day after. So this customer hopefully will clear out, and it won't be an actual customer that will mess up the accounting department. Or you could create another account called accounts receivable, but not have it an accounts receivable type of account so that you don't need the accounts receivable subledger for it. So those are 2 methods you can kind of use. So I'm going to go all the way to the right, or the left, I should say, and we'll do our reversing entry. So the reversing entry, we're just going to do the exact opposite of what we did before. We're going to make it as of the first day of the next time period, 3/1. And we could, since there's only 2 accounts, put the debits on top. But I'm going to keep with the method of the reversing entries being the exact opposite, going from top to bottom, same accounts, but just changing the debits and credits. Because when you get a longer transaction, I think that's the easiest method to do. So I'm just going to keep the AR on top and the unearned revenue on the bottom, but I'm going to represent the accounts receivable as a credit with an indentation in the credit side, and it's going to be a negative representing a credit on top, and then the unearned revenue is going to be a debit on the debit side in the debit column, positive number. Let's post it out. We got the accounts receivable. That's going to be the AR. Now, I need to unhide a couple cells up top because I've got my reversing columns in here. So I'm going to go from AO to AS, right click and unhide those cells. So I'm looking for accounts receivable right here, double clicking on it, going to the end of it and saying plus, putting the cursor back down. We're picking up the unearned revenue, or the accounts receivable. And so there we have it. We were at the 22,771.76, and then we had these 2 adjusting entries that we put in place, both of them being reversed, then these 2 reversing entries, and that brings us back to where we started at after the reversing entries on 3/1. The other side then is going to go to the unearned revenue. That's going to be here, and we are in AP21 equals. Scrolling down, we're going to be picking up the unearned revenue of the 450. That brings it back down to 0. So all we did here, we did an adjusting entry to increase the accounts receivable for those negative deposits that we had in place, and then we reversed it, getting us back to the starting point. We put those into the unearned revenue for presentation purposes, and then simply reversed it back out. No impact in either the adjusting or reversing entries to net income items, that being different than the book type of problem where you would see unearned revenue continually increasing, and then the problem there with your adjustment would trying to be determine how much of the unearned revenue had been earned, which would mean you would decrease the unearned revenue and record the sales. That's not, and then you would not have a reversing entry. In that case, that would be a permanent difference, a permanent change. And what in our problem that we had here with the adjusting process, then we're going to reverse it out so we get back to what the accounting department's going to do, because their problem isn't recognizing the revenue. Their problem is tying out the prepayment to the invoice, which is going to record the revenue at the future point in time. Now, I'm not going to record these to the general ledger because I'm going to keep the general ledger at basically the year end, the 228 information. But obviously in the software, you could then record the added detail to the general ledger. And then you would have to be careful on the subledger as of 3/1. Remember that the subledger now, if I go all the way back to the subledger, and that's going to be way to the right, we basically did a reversing entry. And again, we didn't put the reversing entry. I wouldn't apply it to these actual customers. If the software forced me to use the subledger, then I'm thinking I'm going to put it over here into the adjusted customer. I'm not going to put it in this place at this point because I'm going to keep our GL and the subledgers as of the cutoff date time frame. So that's going to add up to the 151 at this point in time. On the subledger, that should tie out to the trial balance of the 23,151 for the year to date, and then we changed it or brought it back down for the reversing entries as of 3/1. So this is where we stand at this point in time. So this column, of course, being our year to date, this being the reversing entries after the first day of the following time period. And so they're the same down, well, we have the balance sheet accounts down to here, and then the income statement accounts here for the 2-month time frame. And then we rolled out the income statement up to here, you will recall. And so when we're talking about the entries or the reversing entries that happened in March after the cutoff, then we're looking at the income statement only for the month of March here. There was no impact on the income statement, however, from this particular reversing or adjusting entry.